Risk, as you probably know, is measured by the potential for loss. That's typically what people mean by risk. I've had lots of conversations with investors at this point in my career. I've actually never encountered an investor that said, you know what, I'm really worried about making too much money. It's all about loss. And so typically we use the left tail to measure that. The problem is that sometimes an investor might lose money when things go up, right? When you're short selling an asset, you want the price to go down. Or when you're engaging in certain kinds of options trading, you want the asset to go down. And in that case, using a downside measure of loss, the tail probability on the left tail, is not necessarily appropriate. You want to know the right tail. So we split the difference by saying, you know what, let's just look at variance. Let's just look at the spread and use the left and the right sides of the distribution symmetrically. And so in this example, that red curve, that narrower peak, is going to be less risky than the blue curve because the blue curve is spread out more. It's got more probability of extreme returns. Now again, investors might say, you know what, I don't care about this side, I only care about this side. And for certain kinds of hedge fund types of applications, there are one-sided risk measures that only look at the downside. But they tend to be a little bit more complicated and harder to interpret. So for now, we're going to use a symmetric measure, just the fatness of the distribution. That's not a pejorative term, just pointing out that these distributions are wide and the tails are fat. When the tails are fat, it means that it's more likely to get extreme observations. And that can be a problem if you're not expecting the really big losses, although maybe you are willing to take those extreme losses if you can also get the really big gains. So it depends on your preferences. So for now, we're going to use a symmetric measure. And I want to get back to this table that I showed you the very first day of class about historical rates of return, because this is going to be a little bit of a guide to us as to how we think about risk and reward. So remember that I've got statistics on big company stocks, small company stocks, corporate bonds, government bonds, and treasury bills. And you can see this pattern that the higher the risk, as measured by the spread, which is the standard deviation or volatility, the higher the volatility, generally the higher the return. So this is the volatility measure. Large stocks, 20% volatility over the sample period from 1926 to 2015, 10% rate of return on average. Small stocks have a much higher volatility, 32%, so you're getting an extra 2% or 200 basis points above the large stock expected return. And ultimately, when you go down to treasury bills that have a very small standard deviation, 3%, you don't get much of an expected return, only 3%. But you know, that brings up a very important point, which is that this relationship is not a theoretical or mathematical truth, the fact that there has to be a risk-reward relationship. It works out in most cases, but not in all cases. And so there are instances where investors might say, you know what, the risk premium is really not worth it based upon what I prefer to take in terms of the risk. And so Sharpe ratios, the quantity that measures the excess expected return above and beyond the risk-free rate of return, that's the risk premium, divided by the risk, this Sharpe ratio measure does not necessarily increase monotonically with the various different kinds of risks. It varies tremendously across different investments. As an investor, as a rule of thumb, we want to have higher Sharpe ratio assets, and we want to shy away from lower Sharpe ratio assets. But that's, again, a pattern, not a rule. And in my introductory finance class, after I go through the entire semester and explain to them the party line, which is that there should be a risk-reward trade-off, I show them this graph, which gets them terribly annoyed because they think it makes them waste the entire semester. And that's this chart here. This chart shows you that actually, during certain periods, higher risk corresponds to lower average returns. So let me explain what this is. There are two lines on this graph. One of them is volatility using a rolling window of 5 years of daily data. So roughly there are about 250 trading days in a year. 5 years is 1,250 trading days. I'm going to calculate the volatility using daily stock returns for the US stock market. And during that exact same window, I'm going to calculate the average annualized return of the stock market. You understand? So I'm going to calculate the standard deviation, and then I'm going to calculate the expected return. And if finance theory is to be believed, those two things should go together. High risk, high return, low risk, low return. So let's just see how well this theory works. So in the 1930s, which was a very risky period, this is after the Great Depression, in the midst of the Great Depression, after the market crash of 1929, the red line is the average annualized volatility. And we're talking volatility on an order of close to 40% on an annualized basis. Typically, the S&P is about 20%, right, over the long period of time. Well, in the 1930s, it was like 40%. And during that period of time when volatility was elevated, you would think that expected return should be high too. So the blue line is the average annualized 5-year rolling window expected return. Very high volatility, very low expected return. When volatility goes down, expected returns go up. When volatility goes back up, expected returns go down. When volatility goes down, expected returns go up. In fact, if you calculate a correlation between these two time series, it's negative. Negative, not positive. Now, there are lots of clever explanations for why this is the case. For example, Fisher-Black in 1972 came up with a really cool idea of the leverage effect. And here's the idea. Suppose you've got a firm that has some debt and equity in the capital structure, okay? And now the value of your company goes down. The equity goes down because you experience a negative decision by the FDA. So now you are more highly leveraged, right? Your debt to equity ratio has gone up because the value of equity has gone down. If your leverage goes up, what should your equity market volatility do? Go up. The more leveraged you are, the more volatile your returns are. So that suggests that when equity market prices go down, equity market volatility should go up. That's an inverse relationship, right? The leverage effect sounds pretty cool, except for the fact that if you look at firms that have no debt in their capital structure, this phenomenon is even more pronounced. So it's not just the leverage effect. It is what I call, for technical reasons, the freak-out effect. And let me tell you how it works. The freak-out effect is very simple. As an investor, I'm invested in the stock market. When the volatility shoots up to 40%, I look at it and say, you know what? This is way too risky for me. I'm out of here. I'm going to liquidate half of my equity portfolio and put it under the mattress. And if everybody starts doing that over the course of weeks and months and years, guess what? The equity market's going to go down because we're all selling because it's too risky. We're freaking out and putting our money in cash. That's going to cause a negative relationship. So I tell you this because finance theory sounds good on paper and it allows us to derive some beautiful relationships, but it doesn't always work. And there are practical instances where behavioral patterns can overwhelm the theoretical, rational responses. Over long periods of time, yes, there is a positive relationship between risk and reward. If you're looking at it over close to a century of data, yeah, most of the time people are rational. But every once in a while, you freak out. And when you freak out, this relationship goes on vacation. And you have to really be careful about that. If you're managing a biopharma company, you need to think about these considerations, particularly when you need to raise money and the market is freaking out. That is not a good time to raise money. So the practical instances where these kinds of effects kick in are particularly troubling to a company that's trying to plan 5, 10, 20 years out into the future. If you're an app company, I don't think you need to worry about this, right? Your horizon is 6 months, maybe a year. You want to make sure you have enough users and that your take-up rate and your app store statistics are growing. But if you're trying to develop a new drug for pancreatic cancer, you're planning 10, 15 years out into the future. So these kinds of effects become really important. So keep that in mind, that all of the statistics that we're going to derive will have limits. And I'll try to point them out as best I can. But it's important for you to understand how the tools work first before we start beating them up. And I will beat them up mercilessly. but we want to make sure that we understand how to apply them.